No one should have a portfolio built just on hope, especially when we have so much data that suggests how important it is at a time like this to prepare for something that could be problematic. About a month ago, we had some clients describe to us issues they were having with getting cash out of the bank. News media did report certain branches of some of America's largest banks did have that experience, but it was perceived to be very contagious if you needed the physical cash. This week, we actually had clients who have connections with Silicon Valley Bank Corp and also colleagues who have relationships there. And they began to tell us, we heard multiple stories of people who were trying to get their money out and were not able to get 100% of it out. Now, Silicon Valley Bank Corp is primarily an institutional bank, meaning its deposits are primarily commercial, not consumer deposits, not individual deposits. But these were individuals who were unable to get their money out. That was as of Thursday. On Friday, the bank was closed, and the FDIC has stepped in saying that they are going to now be taking over because of the inability of the bank to meet all of its obligations. Now, the press is saying that this is very contained, that it was only because of specific mistakes that this particular bank made and in how they handled it, and in some specific circumstances as to their marks to market that other banks don't have to replicate. And, John Henry, we hope that that is the case, that this is not going to spread any further, that it is entirely contained to this one bank and that everything will be okay. But to us, it's very significant because in the past, as some viewers may know, we had experience with Lehman Brothers. And when Bear Stearns had problems in the spring of 2008, we were told it was ring-fenced. It was specific to that. Subprime real estate was the only part of the real estate sector that was going to be hurt. And for those of us who had exposure to the financial system and built their entire plans and portfolios on the hope that everything would be okay, it was brutally painful. So our thought is, having gone through that, no one wants to experience that. And no one should have a portfolio built just on hope, especially when we have so much data that suggests how important it is at a time like this to prepare for something that could be problematic. Market stress, especially given the tremendous debts that are rolling around in America, as well as globally when you look at all the world's major currency issuers are severely challenged to meet their debt obligations in the best case scenario.
Right. Now, they were challenged prior to the whole COVID thing, but then with COVID, that debt was increased very, very much, was it not?
Dramatically so. So the debt was a concern in 2009 when Ben Bernanke and the Fed first began printing what they said was going to be very temporary. They promised quantitative easing, a fancy word for money printing, where they didn't have to back it by anything. And they told us back in 2009, we're going to quickly retract this money that we've put into the system, and we're going to right-size our balance sheet. But what history tells us is, once a central bank starts doing this, they can never stop, because if they take the money out, it's like something that the markets are addicted to, and they know. That's why they haven't taken it out. It's not like they forgot their promise back to 2009. They just have continually chosen not to do it in any meaningful way. Then, as you're pointing out, John Henry, not only was that concern building, but when COVID came out, we printed an incredible amount of money that, again, is backed by nothing, increasing our debts. And I want to say, John Henry, the money supply that we issued, if you look at the chart, it almost literally looks like a hockey stick where the money supply explodes higher. And I want to say it increased by well over 30%, a ridiculous number for a government to allow to happen. That is what did happen. And so to your point, these debts become even more problematic, heightening even to a greater degree the importance of having an allocation to a portion of one's wealth and something that thrives when debt crises metastasize.
Okay. So you've got this indicator now with the crash of this bank, you had a few little early signs perhaps, but this was big. But have you seen any other signs? Are there any other banks doing something or any other signs that this is something more that we should be paying attention to than just the normal run of the mill?
There certainly are other data points that are very concerning, John Henry, that we think people want to be aware of and not brush these under the rug, but think about what is this really telling me?
Hi, everyone. This is John Henry Westen. We hope you enjoyed this program. To see more like it, be sure to hit the subscribe button below to get all the latest content from LifeSite News. Check the links in the description to read more and connect with us on social media so that you can stay up to date with all the latest life, family, faith, and freedom news. Thanks for watching, and may God bless you.